Hi, everybody. Thanks for coming in. Today's presentation is on debt service coverage ratio lending. I'm going to explain what that is and talk about it. I've got some people coming in with their investment properties at the end, and we're going to evaluate their deals. But this is how real estate investors use debt service coverage ratio loans to buy, refinance, and scale rental property. I used these myself when I first got started, and I wish somebody to explain the ins and outs to me like I was a fifth grader so that I could understand this product. So we're going to talk about it, and I'm going to share my screen with you so you can see a presentation that I've put together, and we'll just run through what is debt service coverage ratio lending and explain it. It's a business purpose mortgage for rental property investors. It qualifies you on one question. Does the property's rent cover its monthly payment? Debt service coverage ratio is what it stands for because the loan is underwritten to the property's cash flow, not your personal income. It sidesteps the biggest roadblocks investors hit with conventional financing. It's it is not non-QM. No, it is non-QM. It is not subprime. These are fully underwritten investor loans offered by established national lenders. It's just measured against the asset instead of your W-2. So it's not subprime. There's no tax returns or W-2s involved. We don't look at your personal income or debt to income. That's not part of the qualification. There's no employment verification. You could be self-employed, retired, between jobs, whatever, it doesn't matter. The property qualifies on this loan. So it's the market rent versus the full monthly payment, the principal, interest, taxes, insurance, and association dues that drives the approval. You can close this in your LLC, vest the title in an entity from day one. You can put it in your LLC, and that's pretty standard, not the exception. So here's the formula. Debt service coverage ratio is equal to your monthly rent divided by principal, interest, taxes, insurance, and association dues. Rent comes from the appraiser's market rent analysis, the appraisal, or your signed lease, whichever the program uses or whichever one that you have. So a DSCR of 1 means the rent covers the payment. Exactly. For example, if your payment is $1,000 and your rent is $1,000, that's 1. Here's another example. Market rent is $1,800. That's your full payment. Your full payment is $1,500. So if you divide $1,800 divided by $1,500, you get 1.2. And you can try that out on your calculators if you like. So how rent is counted? The number on top of the ratio has its own rules. Your DSCR is only as strong as the rent figure the lender will accept. And that figure is not simply whatever the lease says. So you have a signed lease, the executed lease on the property. Underwriting wants the document itself, and the tenant must be an unaffiliated third party. You don't always have to have the signed lease. You can do a vacant property. So you can take the appraisal market rent and use it to determine how much rent we're counting. So this is what lets a vacant purchase qualify. So you can have a vacant property not rented yet and go ahead and get a DSCR loan. So lenders qualify oftentimes on the lesser of the two. Some lenders will take the greater of the two. It depends. But if one exceeds the other by more than 20%, the qualifying figure is capped at 120% of the lower number. So here's an example of calculating DSCR line by line so we can break it down and not be confused about it. So you have principal and interest payments. Let's say it's $1,279. Then your property taxes are $260. You have insurance, let's say $95, and HOA dues, let's say $45. So that full payment is $1,679. That's the principal, interest, taxes, insurance, and association dues, and that's the number you go by. And be honest about that number. look into how much is the insurance actually going to cost. What is the property tax going to be after I purchase the property? The current property tax is not what it's going to be after you purchase it. What is the property tax going to be? Get that number to fill that in correctly in the calculator I'm going to give you, because you want to be honest. What is the full monthly payment? Then get your market rent. It comes from the appraisal. I can send you a report to estimate what that number would be, because you're not going to have the appraisal to start. Just let me know you want that and I'll send it to you. Let's say from the market rent on the appraisal comes in at $1,950. So you're going to take that $1,950 and divide by 1,679, and you'll get 1.16. That's your ratio. What trips most people up is that their tax resets on the purchase price, not the seller's current bill. Okay, so work with me and I'll make sure we get that number right. The landlord policies with rent loss coverage cost more than the homeowner's policy. So talk to your insurance person and make sure you've got the right amount for your insurance. You may have to have flood insurance, so we need to look into that. Now, you can also do interest only programs to qualify. So if we need to get your DSCR ratio up, we can do interest only on the loan, and that will lift the ratio for you. So let's talk about this ratio number. Once you figured out how to determine your ratio, your debt service coverage ratio, find that number. Be as honest with yourself as you can to get that number. I'll give you a calculator to calculate it. Let's say it's 1.25. That's strong cash flow. So that's best pricing tiers with that. Lenders are competing for your deal. You got the best thing going. If it's 1 to 1.24, that covers the payment. That's fine. Fully approvable at most investor standard terms. But you've got you may have a moderate pricing adjustment compared to the top tier pricing. If it's below 1, that's acceptable. There are lenders that will do it and we can take it there. It's still financeable, but you're not going to get the best pricing. So there's going to be higher. What that means to you is going to be higher interest rate. So ratio and terms vary by lender and program. This is why you need to work with your favorite mortgage broker. Go work with me or someone else, but get your favorite mortgage broker, have a conversation with them, determine your debt service coverage ratio number. If it's below 1, you need to know it, and then they're going to find your broker. I will find the lender for that, or your broker will find that lender. So who debt service coverage ratio lending is built for? This is perfect for self-employed investors, because a lot of times self-employed investors have their write-offs shrink their taxable income. DSCR ignores that entirely. You want to close in an LLC or an entity, short-term rental owners, or portfolio builders, like you're building more than 10 and you know it. So, you're going to go above 10, or you've reached 10 conventional and you want to go beyond that, you can do debt service coverage ratio. W-2 earners maxed out on their debt to income. So you may be a W-2 earner and you're maxed out on your debt to income on your personal books. So you need to move it over to a DSCR. And first-time investors can do this. You can get a DSCR loan if you're a first-time investor. I was a first-time investor once, and this is the investment program that I used that allowed me to scale my portfolio pretty quickly. So for first-time investors, it's widely available. The usual requirement is that you already own your primary residence, or that you're renting somewhere. It is possible to not be paying rent and living rent-free, maybe with your parents, and do this. It's just there's very select lenders that do that, and you won't get best pricing. So let's talk about debt service coverage ratio versus conventional financing. So you have the same property, but doing it in 2 different ways. So if it's a DSCR, the qualification is the property has to cash flow. If it's conventional, you just need to be able to cover that payment personally, including the rent. But if you can personally cover that payment, you can do conventional financing. On the documentation, on the debt service coverage ratio, you got to have lease or market rents off of the appraisal. On conventional, you're going to have full income docs, W-2s, tax returns, pay stubs, all the things for conventional financing. And on the vesting, In the DSCR loan, you can hold title in your LLC or entity at closing. And on conventional financing, you have to hold the property in your individual name only. Okay. On the DSCR loan, like I've already said, there's no agency 10 loan limit. On conventional, it's capped at 15 financed properties. You can only do, no, not 15, 10. On conventional, your investment properties are capped at 10 financed properties. On DSCR, there's no limit. So speed on the DSCR, if you have a lien file, you can get faster underwriting and approval and close quicker. On conventional, we have to do the income analysis. It adds time and conditions. It can be done, sure. It's just going to take a little bit more time. So the trade-off too is on the DSCR is a moderately higher rate sometimes, most of the time, not always, and a prepayment penalty most of the time, not always. In conventional, you've got the lowest rate and no prepayment penalty. So what lenders actually look at? So let's say you want to get a debt service coverage ratio loan. You're coming in the gate. What are lenders going to look at? They're going to look at your credit score. Minimums commonly start in the 620 range, 620 plus. You can get lower than that, but again, there's very select lenders that do that, and you're not going to get best pricing. So the best pricing lives at 740 and above. So they're going to look at your credit score and then the loan to value of the property. We're going to talk about loan to value. Loan to value, typically up to 80% on purchases and rate and term, 75% on cash out. The lower loan to value is a better rate and more options on lenders. The debt service coverage ratio, looking at that, the ratio itself, 1.25 and above unlocks the top tiers. 1 is standard. Less than 1 narrows the lender pool. And then reserves, usually 3 to 6 months of principal, interest, taxes, insurance, and association dues, and liquid assets after closing. So you need to have reserves. More for larger loans or lower ratios, and it depends on the lender. Also, we look at the property type, the loan size, the prepayment structure, and recent mortgage history. Rules every DSCR file must meet. It has to be business purpose only. The loan must be for an investment. You cannot occupy the property, and it can never be a primary or second home. Arm's length tenants. Each occupant must be an unaffiliated third party. A family member on the lease disqualifies the rent and usually the file. No personal income on file. Employment and income are not listed on the application at all. There's no debt to income to calculate, fix, or explain. And current on everything. All housing and mortgage obligations must be paid current at application and stay that way through closing. In other words, don't be late on paying your mortgages. Mortgage lates are a bad idea and to be avoided at all costs if at all possible on your primary home and your investment properties. So make sure that you are current on everything. If you get behind or you are late, it can still be done, but it's difficult and you won't get best pricing. There's an experience requirement. This is commonly required, but also commonly waived. Investors like to see an experienced landlord, and they'll give you better pricing for that. However, if you are a first-time investor and you want to use the debt service coverage ratio loan, you can, okay? You just won't get as good pricing as somebody that has a lot of experience. So many DSCR programs look for 12 months of owning or none. Some of them look at none. So just have a conversation and we'll talk about it. Many lenders will waive the landlord rule. Owning your primary residence is usually good, but not required. Living rent-free sometimes works with a letter from the owner. Some lenders require the rental to be in a different market than where you live. Expect a 680 credit floor and a 1 DSCR minimum. Now, I did say 680 credit score. However, I do have a lender that will go down to 600. So we can do it. Just call me and we'll have a conversation. But it's always a good idea to protect your credit score and get it as high as you can, and you'll get best pricing. So credit and housing history, no 30-day lates in the last 12 months on both the subject property and your primary. That's rarely negotiable. So make sure you're up to date on your housing history. You want a 0.75 to 1 minimum DSCR, but you're not going to get good pricing if it's under 1. You won't get the best. And then 3 years on a credit event. So if you've had a Chapter 13 or something negative on your credit, it will take some time for that to fall off for you to participate in the debt service coverage ratio loan. First time investors are allowed. Primary home needs to be in place. Nearly every program requires you to own your primary residence or have a rental agreement. Living rent-free works with a letter from the owner at select lenders. Typical entry, 680 credit score and a 1 debt service coverage ratio loan. We can go below 680, definitely not below 600. Now, this is a confusing slide, and I wanted to talk about this and just show this to you. I'm not going to go through this slide. Just want you to see. I actually did the research on lenders, lots of lenders. That's my job. That's what I do. But I put some in the slide, and let's call them lender A through lender H. They're all different. They all have different requirements. It gets very confusing looking at that. But it's not your job to know that. It's not your job to know what these lenders offer. You just give me a call. That's what I know. Tell me everything there is to know about you. We'll get all the details of your scenario, and then I find the correct lender for you. So it's not your job to know this. It's mine. Just call. Let's have a conversation. Everything starts with a conversation, and we'll figure out which lender works best for you. So eligible properties and loan purposes, property types, single family houses, 2 to 4 units also qualify for debt service coverage ratio, condos, townhomes, short-term rentals. You can get a short-term rental on a debt service coverage ratio loan. Absolutely. Call me and we'll talk about that. You can also get debt service coverage ratio loan on 5 to 8 units on the small multifamily. There are select lenders that do that, and I've done that for investors, and they're very grateful sometimes for that because it's a little bit difficult to find at times. But you don't have to call 100 different lenders and figure out who will finance your 8 unit. Just give me a call. I already know who the lender is, and we'll get you lined up. Okay, there's a handful of them, and they do DSCR loans on those smaller units. Loan purposes, purchase typically up to 80% loan to value with qualifying credit and ratio. You can do a rate and term refinance. So sometimes investors come to me and they have a hard money loan on a fix and flip. They did a fix and flip, have a hard money loan, and now they fixed it up. Property's beautiful, have a tenant in place, and now they're ready for that nice 30-year financing, and they need a DSCR loan. So if you call me, we'll get that lined up, find the best lender for you, have conversations about it, and close on it. And then you have 30-year financing and you pay off your private money lender or your hard money lender. And it gives you better terms because, your hard money lender is going to be higher interest rate. But once you get that property stabilized and refinance into the DSCR, you're going to have a lower payment. Sometimes investors call me for the cash out refinance and you want to pull out equity. So you can pull your equity out up to 75% of the loan to value. And you can use this money that you pulled out on your equity to purchase more property. So you could pull the equity out and maybe that equity would purchase you 2 additional rentals. So you can do that. Okay. Or you can pull that cash out to pay cash for your next flip. That's something to do. So it depends on what your goals are and what you want to do with it. And the lender really won't ask you and is not concerned. They just, they'll typically loan up to 75% of the loan to value of the property. And then you can take that capital and work it how you see fit as the investor. So closing in your LLC, entity vesting is standard practice. If you close it in your LLC or your entity, you have asset separation, you have cleaner books, you have a credit footprint. The mortgage typically reports to the business, not your personal credit file. So typically it won't show up on your personal credit report. What the lender will ask for, though, is your articles of organization for your entity, your operating agreement, your EIN letter, certificate of good standing from the state, and personal guarantee from the members. So the personal and guarantee on a DSCR, and then they'll approve your entity. Now, let's talk about prepayment penalties because this is a conversation I have quite a bit with investors and it's unclear sometimes. So most DSCR loans carry a prepayment penalty for the first 1 to 5 years. Not all. You can get DSCR loans with no prepayment penalty. It just won't be the best interest rate. So usually investors choose a prepayment penalty to get a better rate. It compensates the lender if you pay off early. It's also a lever. So a longer prepayment penalty buys you a lower rate. Sometimes there's a step down structure where the penalty declines each year. So it can go from 5 to 4 to 3 to 1. 5, 4, 3, 2, 1 is 5% of balance in year 1, stepping down to 1% in year 5. So it decreases each year that goes by. A flat structure has the same percentage for the whole penalty period, like a flat 5% for 3 years. It's simpler, but no relief in later years. It's used by some lenders, so always confirm before locking. Have a conversation about your prepayment penalty. Closing in your LLC, we already talked about that. And then we talked about the prepayment penalty. Let's talk about your interest rate. So these things have an impact on your interest rate on a DSCR. A small loan balance may have a higher interest rate. 2 to 4 units, condos, that will affect your interest rate. If it's a cash out versus a purchase, this will affect your interest rate. Cash out refinances typically have a higher interest rate than a purchase. If there's no prepayment penalty, typically going to affect your interest rate and have a higher interest rate. If you have a debt service coverage ratio below 1, typically going to have a higher interest rate. And then your FICO score, your credit score, and your loan to value tier is going to affect your interest rate. So if you bring your loan to value down 5%, this often jumps a full pricing tier. So for example, if you have if you're an investor and you want to put 25% down instead of 20% down, you're going to get a better interest rate. Okay. Or accept a longer prepayment penalty if you're holding it. So if you're a buy and hold investor, you're like, I know I'm going to hold this property 10 years. And if you get a 5% prepayment penalty, you're going to have a lower interest rate most of the time. You can do a rate buy down or use documented rents to get a higher DSCR score. And the higher the score, oftentimes the better the interest rate. And your credit score really matters. You can get DSCR loans with a lower credit score, but you're going to take a hit on that interest rate. So 20 points near the bottom of the credit score can really affect your interest rate. If you get up to the higher 700s on your interest rate, it doesn't matter. On your credit score, if you're in the high 700s, it doesn't matter so much. Your interest rate is going to be great if you're at 780 or 800. Okay. But if you're down in the low 600s or a 620 and a 640 and a 660, those make a real difference. Long story short, protect your credit score and let's get it as high as we can. So what you need when you apply, if you want to get a lien file together, you can do it. You can do it pretty quick. There's a loan application and a credit pull, and that doesn't take very long to do at all. You need your property details, gather that up, the address, the purchase contract if you're buying, your current lease if you have it, short-term rental history if that's applicable, your insurance quote, make sure you get a quote for a landlord policy, your bank statements to cover your down payment, your costs and your reserves, and your entity documents, your LLC docs, operating agreement, that type of thing. Don't worry about the appraisal. I'll order that for you, or your lender will order that for you. And that'll include the market rent analysis that's at your DSCR. And all of this can be done pretty quickly. Pro tip before you apply, Vacant is okay. So if your property does not have a tenant, it is okay. Just need to know that up front. There are certain lenders that are friendly to that. Typically, they don't have the best interest rate. It's often better to already have the tenant, but you don't have to. Protect the payment history. Recent mortgage rates are treated very differently lender to lender. So tell me early or tell your broker early that you have mortgage rates so the file is placed correctly. I recommend don't having mortgage rates, but life happens and sometimes we do. So if you have mortgage rates, tell that up front and we'll put it with the right lender. Pay attention to the small balances. Loans under 100,000 eliminate most lenders. So a short list of lenders is there for that. We just need to know that. So we can do under 100,000. It's just there are only a handful of lenders that do it. Estimate your principal, interest, taxes, insurance, and association dues honestly. Talk to your broker, make sure those numbers are right, and let's get that DSCR ratio dialed in. Okay, if you have questions, and I know there's some people waiting to ask their questions, we're going to open it up for questions. But you can bring me a scenario, an address, estimated rent, credit range, and goal, and I'll price it for you and show you the best structure and find the best lender for you. You want to scan that QR code? That's a little questionnaire to get you lined up to answer those questions. So fill out that questionnaire and I'll give you a call and we'll run through your scenario. Thank you so much. And I hope everybody has a great day. And if you're hanging out to get your questions answered, I'll talk to you after. See you there. Bye, everybody.